Hey everybody, earnings season is now just about in the books. We are going to take a look at SoFi's earnings, one of my favorite companies to follow around earnings season time. So before we do, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from my sponsor, The Motley Fool. It's the best way to support this work we're doing here on YouTube. Again, that is fool.com/Frankel. So let me share my screen real quick. We're going to talk about just some of the company's results and what they mean and how I'm interpreting them and kind of what I'm looking forward to. Because there is good and bad, and every stock in SoFi is no exception. So this is from the company's recent earnings report. This is the member growth over time. And as you can see, membership has grown a lot. They added 643,000 members in the second quarter. It has grown by 41% year over year. One thing to note, and not to be alarmed about, because 41% is still a very impressive growth rate, especially as the business scales. The growth rate has decelerated somewhat over the past year or so. 3 quarters ago, it was 47%, then 44%, then 44%, now 41%. 643 is still the biggest 1 quarter addition of new members. That growth rate is going to slow over time. You can't maintain 40% growth in a bank forever. But as long as the new member additions, if this number right here, that's actually not the highest, it's the second highest. But if that number stays elevated, I would be very, very happy to see that. But the deceleration of growth is something to keep an eye on because the market will react to that. So the other thing I wanted to mention, there's a few things I want to mention. I'm going to scroll down to a different slide right here. And you can see this is called their financial services productivity loop. And in simple terms, this means that there's two different types of products in SoFi's portfolio. There are financial service products, which are things like their bank accounts, credit cards, brokerage accounts, and there are lending products, which are its personal loans primarily, but also its student loans, home loans, and I'm sure more will be added over time. The idea is that they want to focus their growth effort on the financial services products, checking accounts, and things like that, with the idea that the higher the ratio is between financial service products and lending products, the more of a natural marketing funnel the company has to, cross sell other products to. Right now, its customer acquisition cost is very high, and this is one of my biggest negatives about SoFi. They offer large referral bonuses to get people to refer their friends for personal loans, to refer their friends to sign up for checking accounts and credit cards and things like that. But you can see here, since the middle of 2021, the ratio of financial services products to lending products has grown from 2.7 gradually up to 6.2 where it stands now. And the idea is now, just some quick math, you have about 9,000 SoFi customers at a minimum that don't have a loan with the bank already. And that's 9 million. So that is a natural marketing funnel that you can kind of try to sell loans and increase your relationship without that big customer acquisition cost. It makes it a whole lot more efficient to grow the business. Actually, so with the recession looming, there have been natural fears about loan quality. And to be fair, SoFi's loan loss ratio is higher than I would expect. You can see this top gray line here are loans that were originated in 2017. So they've all been paid back at this point. They've either all been paid back or they've defaulted at this point. There's none still outstanding. They had almost an 8% cumulative loss over the life of those loans. That's not great. If your average personal loan, say, is 10 to 12% interest, and you have an 8% loss ratio there, that's not a fantastic margin. The good news is the newer loans that they've made, which are pretty much all these other lines on this chart, are performing better than the older ones. It remains to be seen if these lines will continue to grow, continue to flatten, whatever they might do. But so far, they're performing pretty well. I would love to see them get that credit quality a little bit higher. You can see right now, cumulative to date, this is throughout SoFi's entire history. They have about a 6% net charge-off rate. based on or a net cumulative loss rate based on paid off balances. So we have to assume that's going to continue. I would love to see that get a little bit lower. So beyond that, let me see what else I have here to talk about. Here's a potential negative. Growth is a little bit slower than I would like, but this is by design. SoFi, because of the uncertain economic environment, SoFi has intentionally pumped the brakes on growth. So I'm not reading too much into it, but it's something to watch. Profitability is down a little bit, as you can see right here, for the quarter, and not really too much to be concerned about. The company did increase its full year guidance. You can see it's kind of faded right here, but their revenue guidance is up. Their adjusted EBITDA guidance is up. Their net income guidance is up. EPS outlook is up by 1 cent per share for the full year. So that is pretty impressive. This is a profitable bank that's growing at 40% plus. And I can't see why the market isn't rewarding it anymore. I definitely get the risk factors. The loan loss ratio is a risk, especially as it grows. And I am not too thrilled with some of its newer initiatives, specifically credit cards. The credit card products that they have recently announced, they're nothing to really get too excited about. I kind of expected more differentiators, which could still come. But definitely keep an eye on the losses. And one other thing to keep an eye on, the tech platform, the Galileo platform. So it's kind of a mixed bag. On one hand, let me go up here. There it is right there. You can see they reached 158 million accounts on the Galileo platform. That's 23% year-over-year growth. That is a big acceleration, and that is their fastest growth rate since the end of 2022. So that's the account total. On a profitability basis, the growth hasn't been quite as impressive. If I look at the breakdown of their contribution profit from all their businesses, which this middle bar is the technology platform, it is it's been flat for the past 4 quarters. Even though the number of accounts on the platform has gone up, the contribution platform from Galileo has been flat. I would love to see that play more of a role. And just to kind of, for comparison's sake, in 2023, the Galileo platform's the contribution profit was about $95 million. That is compared to about $823 million from the lending business. So still a very, very small part of the business. The company says it wants to use that to be the, quote, AWS of finance, and it has a way to go before that is even remotely part of the reality. So I'd love to hear what you think about SoFi's quarter. Please leave me some comments. I'll do my best to answer any of them individually. And thanks for watching. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.